Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This video is part 5 of my continuing series where I'm covering all the various sectors as reported and presented by FactSet. The sector I'm covering today is consumer services, and this is kind of an interesting sector. It's comprised of companies like media conglomerates, broadcasting companies, cable and satellite TV, casinos and gaming, hotels, resorts, cruise lines, restaurants, really just companies in the service sector. And as I kind of indicated in the written portion, it's not a sector I'm real excited about. There are a couple of companies in here that I kind of like, but there's also some issues. For example, I think these companies tend to be very difficult to predict and forecast because there just isn't a lot of consistency and predictability to their earnings or their operating results, especially like movie companies, whether a movie's going to be a bust or not. That would be the same with cable and satellite TV, whether they're keeping their subscribers or losing them, and whether, other disruptive technologies are coming along. So, there's a lot of uncertainty in this particular sector. A lot of these companies are not necessarily essential things that people have to have, but some of them probably have become that way. Things like cable television and satellite is certainly something most people won't do without. But regardless, it's just not a great sector. If you look through this sector, a lot of these companies are smaller. A lot of them tend to have a high level of debt. One of my criteria I'm looking for with this particular series is credit ratings, investment grade credit ratings of BBB- or higher. I had trouble finding companies that met that criteria in this industry. But regardless, there are some good examples. Now, the first company I'm going to cover here is Comcast. From the standpoint of operating history, this is kind of an interesting company. They didn't make any money from 1999 up through about 2003. And I want you to notice their stock really flatlined for all these years. Between the 2001 recession and the Great Recession, the company literally made no money for its shareholders at all. But then, starting in 2004, and as we kind of went through the recession pretty well, actually, they started paying a dividend in 2008, which was interesting. So if I shorten this time frame to where I start looking at what I'll call the profitable years, the company's earnings growth has averaged about 17.5% a year. That's really excellent. I want you to notice how the price has tracked the earnings. That's the orange line and the blue line. And this stock trades in between. This is using a P equals growth rate formula. So this orange line under this time frame is a PE of 17. The blue line's a PE of 18. In other words, this company trades somewhere between, I'm going to say 16 to 19 or 20 times earnings historically. Here at the high, it was trading up at 21 times earnings. Down here, it was trading at 14 times earnings. But the point is, notice how the price tracks the earnings. And right now, you see that the price is trading at a blended PE of 14.4. It's below the normal PE of 18 or the growth PE of 17.5. So from that view, it's kind of cheap. It's offering a 2.3% dividend yield over this particular time frame, which is the life of their dividend. Their average growth of their dividend has been, in the 20% range. Compound average growth 19.8, average 20.1. So the company's produced good dividend growth, and it's got a decent current yield, a lot of it attributed to the low current valuation. It's got an A- rating. It's a $168 billion market cap, but it does have 58% debt. Now, this company owns, broadcast TV and cable networks. They also own theme parks like the Universal theme park in Orlando, and as well as theme parks in Japan and California. So it's really kind of an interesting company. One of the more interesting ones here, if I look at it from a future point of view, if I look at forecasting, there's quite a few analysts follow it. For 2019 and 2020, we're forecasting 7% growth this year, which might also partially explain the lower valuation relative to what their historical norm has been, but then back up to double-digit growth for 2020, 21, and 22. Of all the companies in this sector I'm going to look at, they also have one of the best analyst scorecards. If you look at their analyst scorecard, look at the summary, they have either hit or beat estimates 100% of the time. They've hit them 80% of the time on a 1 year and beat it 20% of the time, and they hit their estimates 100% of the time on a 2-year forward. Now, that's going back to 2009, okay, which is as far back as I can go with FactSet data. So you can see they've got an excellent record. So that just simply tells me that of all the companies in this sector that I'm going to be covering today, this probably has the best scorecard. It has good estimated growth. You can see the total annualized rate of return, assuming a PE of 15, which is lower than its historical norm, would give you a 14.9%. If I went to the normal multiple of 18 or 19, I'm going to shorten that. I'm going to pick a multiple here that's closer to, it's a little more conservative. I'll do 17.8. That's kind of between the historical calculation of a 17.5 and an 18.2, just so we're clear. And if I look at that, this year, if it goes back to that PE, it could be a 39% annualized rate of return. The 2-year annualized over 27%. And even going out to 2022, the annualized rate of return would be double-digit over 20%. So this stock looks very attractive to me. It's a good company. It's highly rated. It does have a little bit of debt, but I do think the valuation is very attractive. If you're looking at it from a standpoint of this year, this is one of the weaker years they've had. If you look at the bottom here, you can see the change in earnings growth. They had a weak year in 2010, but otherwise they've had some really strong earnings growth, a weak year in 2016, but then they followed that by 18 and 24% for 2018, and then 2019 we're looking at a 7% growth, a little flattening, but then followed by double-digit growth again. So this is Comcast. Of all the ones I'm going to look at here, I probably like it the best from a quality and a consistency point of view. The next company I'm going to look at is Discovery Inc., and it's a growth stock. It pays no dividends. It's BBB- rated, has a lot of debt, 62% debt, but I'm really showing this as a really undervaluation opportunity here for pure growth. As a content provider, people probably very familiar with the Discovery Channel and Animal Planet and the Investigation, Discovery, and Science networks that I talked about in the written portion. So it's kind of got good content. The company is extremely undervalued. If I look at forecasting graphs, this year is expected to have a very strong growth. There's 21 analysts expecting a 64% increase in earnings for 2019. So on that basis, the company would be very, very attractive. It could virtually double by the end of this year, and then followed by a little bit of flattening and 9% growth in 2020, and then back to 13% growth. So it has very great growth potential. I want you to notice the summary of the analyst scorecard here. So if I go ahead and go into the analyst scorecard, I want you to see that from a summary point of view, the company has missed their 1-year forward estimate about 40% of the time. Their 2-year, interestingly enough, is a little better, but keep in mind, I give a 20% margin of error on the 2-year and only a 10% margin of error on the 1-year. So the bottom line is, how predictable and how realistic these numbers are. If I look back at the company from a historical point of view, there is some cyclicality. We've had a flattening of earnings for the last couple of years. Actually longer than that. We had a down year in 2015, but this is, kind of a deja vu all over again, as Yogi Berra once said, kind of scenario to where we are today. They did follow that up with a very strong year in 2016, but we didn't see much in the way of price results. So this is strictly an undervaluation situation. There's no dividends. It's basically all about whether you believe the market will turn around and start liking this company in the future. So there's Discovery. My next example is eBay, and this is kind of an interesting, the shopping company. Now, what I've got here, I've got kind of an interesting graph here. I've not adjusted the operating earn results because you all probably familiar that eBay sold off PayPal, but the stock price has been adjusted for the PayPal spinoff. So the chart here is a little bit aberrant. If I'm really looking at this stock, I'm probably only looking at it post eBay. Let me get it down to where eBay is here. So I'm only looking at really, earnings since 2016 and 17, but it's been tracking their earnings very well. Growth has been 10%-ish. The performance of the company has been consistent with its growth. Now, what's interesting about this stock is, I don't really show it on this graph, but they have started paying their first dividend, 14 cents a share. It's not showing up yet on the fast graph other than in the fast facts box, but if I go to the forecasting calculator, we are showing the 14-cent dividend or 56-cent estimate for the year. It's just not showing up on the graph. The company is not necessarily cheap at these levels, but it's probably reasonably priced if you believe the growth is there. Again, the analyst scorecard is decent. It's not as bad as some we're going to look at, but they have had misses. Otherwise, the analysts have been getting the earnings right. So, you could put a reasonable amount of credibility into their forecast. The long-term growth rate is expected to be about 8.7%. So again, it's starting to pay a dividend. We don't really know what that dividend is going to look like yet. It's too new. But anyway, that's eBay. It's got 50% debt to capital and it's BBB+ rated. My next company is Viacom, and this is another interesting company, a summer redstone company. I do want you to notice the cyclical nature of this stock. Now, the company also spun out of CBS, and there's talk about CBS and Viacom merging again because the Summer Redstone's family is I guess his wife controls the holding company that owns the majority of the shares. But I want you to look at the chart pattern here just from a standpoint of fundamentals. You can see that tracked earnings growth when it was strong, and then we had this dividend cut and a drop in earnings, and you see the price, fall fall rather dramatically. Probably the salient feature here is the stock is extremely undervalued relative to forecast earnings growth, but forecast earnings growth is really not too favorable. We're only talking 3 or 4% growth. So if we look at this company from a normal 10 multiple, and I want to focus on that because I want you to see that the 10 PE here, it's actually calculates 11.9. So let's say 10 to 12 normal PE, depending on what time frame you draw this at. You know, here I'm down to an 8.5 PE. I want you to understand that's a variable number, but just using that 10 PE is kind of a benchmark normal valuation. If the stock traded from its current 6.8 PE, it could be very attractive. If it, you know, you could have a doubling of your money by the end of this year, followed by some double-digit returns going forward. The analyst scorecard on this particular company is kind of spotty. You know, they have had misses, and sometimes their misses have been great. So it's just, you know, I don't know how much credence I give to these forecasts on this particular stock. Again, this isn't an industry I'm real enthusiastic about, but I want you to see how different these companies are than some of the other sectors I've previously covered. A lot of cyclicality. The company's been paying a dividend, but their dividend record is spotty. So these are all things you should take into consideration. The appeal for this particular stock is the extremely low valuation currently. And this brings me to CBS, kind of the other half of the equation here. I'm only going to show CBS since it was spun off from Viacom. There's no reason to look at it going back to these old years here because this is all, you know, muddied by the fact that it was spun out of Viacom and we've got CBS here. But I do want you to notice how price follows earnings. This is such an important principle. In the long run, the company's operating results are what generate shareholder returns. Now, you get the short run market stuff where you get overvaluation and periods of undervaluation. But notice when earnings collapse here, the price collapsed. They did cut their dividend during the recession. Their record coming out of the recession has been good. Their growth has been, you know, double digit. Let me shorten it one more year. Their growth has been over 20%. It's averaged about a 16 PE during this period of time. So if I'm looking at forecasting graphs, and I've got a PE of 15 here, so this is 15.5 on this graph right here. So that's, you know, close. You know, you could see the rates of return would be quite good. But again, it's not a company that I, you know, feel real good about from a standpoint of long-term history. The attraction here is undervaluation and the possibility that they're going to merge or be acquired by Viacom. The company does have an awful lot of debt. It's BBB rated, does offer a modest dividend yield. Again, the big attraction here is a 9.1 blended PE. Now this moves me into the cruise lines, or at least one of the cruise lines, Carnival Cruise Lines. These are also very interesting stocks. I want you to notice that, you know, you had pretty spotty record of operating results. They cut their dividend, eliminated it completely during the recession. They started paying one again in 2010. The dividend's grown nicely since that period of time. So if I look at it from a shorter period of time, you know, it's interesting. The price and earnings relationship is pretty strong there. From a forecasting point of view, it is expected to grow at double-digit rates over the next couple of years. It's, you know, moderately undervalued. The normal PE has been about 18 for the last 5 years. That would give us a, you know, really high rate of return. So I just think there's a lot of speculation. Now, this particular company is A- rated, so it's a good quality stock. It only has 23% debt. So it's, you know, maybe one of the other favorites I might have just from a standpoint of quality and fundamental value. It's not dramatically undervalued, but it's cheap enough, or it actually is pretty undervalued. It's cheap enough to be a good opportunity going forward. You know, cruise ships have kind of become very popular in recent years, so we're going to look at Royal Caribbean here in a minute also. However, before we move to that, I've got my next stock up on my thing is H&R Block. And again, this is a customer service, you know, taxes, obviously, clearly. I want you to notice this company's really done nothing from an operating history. It makes money every year. I think that's important to point out. Its dividend record is, you know, okay. It's had decent dividend growth at times, but it also has periods where they freeze their dividend. But the average growth has been about 5% historically. But again, it's not real predictable. Their forecasts are a down year this year, then followed by very modest growth in 2020 and 21. But we don't have very many analysts forecasting it. Their analyst scorecard is probably the spottiest of all. You know, they've missed earnings 50% of the time on the 1 year forward and 60% of the time. So this is a classic example of how you've got a lot of cyclicality here and not a lot of predictability. It does offer a 4% current yield and a low valuation, and that's probably the most salient feature here. The valuation is low, but the growth and the opportunity going forward is kind of low also. So this is one I'd be careful with, but it is reasonably cheap, BBB rated. It does have a lot of debt, but a lot of that debt I think has to do with the way the company loans money and runs their business. My next research candidate in this is going to go back to the cruise lines. I'm going to go to Royal Caribbean here, and it's to me it looks an awful lot like we saw with Carnival. So these are kind of industry specific numbers more than they are individual company numbers. We had a similar situation, not great operating history cut back here. We had a dividend cut. We've seen nice dividend growth since. As we shorten this coming out of the recession, we see good growth, 16.4%. That gives us a 16 PE. On that basis, the stock is undervalued. It has 38% debt. It's BBB minus. The analyst scorecard here, again, is kind of spotty. The analysts have missed forecasts 40% of the time for the 1 year and 30% for the 2 years. And all that means to me, I want to be clear what I'm saying here. It just means that, that these misses can be rather dramatic. So let's go ahead and look at the 1 year misses here. This was the recession now. So they were forecasting $1.93. The company earned 75 cents. So that was 157% miss, if you will. They missed it by more than they were forecast to make. Here the miss was 18%, 58%, 12%. That was for 2011, 12, and 13. This is what the analysts were forecasting. This is what the company actually made. So again, this is not an easy company to forecast. So even though these numbers look real attractive here, I would be, more cautious. I would really be paying attention to my due diligence on this particular company. So anyway, that's Royal Caribbean. It looks a lot like we saw with Carnival Cruise Line. Assuming the economy stays good and these, cruise ships stay popular, there is some opportunity here. But again, it's not an industry or a sector that I'm just real interested in. This is Transcontinental. This is not a company I'm real familiar with. It's a Canadian company. But if I'm just looking at the graphing here and the data, you can see that, earnings growth has been very low at about 4%. I also want you to notice that the company trades at a very low normal valuation of about 8 times earnings. So when I'm looking at forecasting this company, I definitely want to look at the normal multiple. And if we're looking at a 7, 8, 9, normal PE, and you can see those numbers here, that's about what this company is historically traded at, depending on what year you're measuring it. Remember, normal PE is a dynamic calculation. So just using this 7.8, or we could, maybe even be fair and do a 8.5 PE. Go ahead and apply that. There would be some money to be made here. The analyst scorecard is better than we've seen with some of the other companies. They've only missed 10% of the time on a 1 year forward, and they've been right 100% of the time with a 20% margin of error on the 2 year forward. So, the big story here is it pays a decent dividend yield. The company's BBB minus rated, has 39% debt, and it's moderately undervalued with a blended PE of 7.6. So again, not anything I'm super excited about. If you notice, long-term performance has underperformed the market, generated about the same dividend income. The key here is, do you like the valuation and do you like the current dividend yield? So that kind of sums up my review of this particular sector. The consumer services sector, again, is not one that I feel real comfortable with. But remember, the goal of this presentation or this series of articles is to show you how different companies can be in different sectors. Always remembering it's a market of stocks, not a stock market. And more than that, it's also a market of sectors. Not all sectors are the same. So anyway, it's been Chuck Harwell. I hope you enjoyed this video. Look forward to talking to you soon. Thanks for watching.